So we're talking about, before we talk about the hedges, let's talk about why the hedges. And what we have is generally a pretty toppy market. This is a weekly chart of the S&P going back till 2021, or really 2020, almost over there, or late, after the beginning of 2020. And 2020 started right about here at 3,200. 4,800 is 50% higher than 3,200. So you're going to get a pullback. When you have a 50% gain, you're going to get a pullback, and the pullback should be 20% of the gain. So if the gain was 1,800, a pullback would be 360 points. So call it 400 just to be, to be on the even side. So from 48, your next significant pullback is going to be 44. And you see what happened here? See how you immediately pulled back to 44? That's where we call the weak bounce zone. And then you want to see if you retrace, and a retrace, this is a weak retrace. This is a weak bounce from the weak bounce line. I'm sorry, it's a weak retracement, not a weak bounce. So this is a retracement. So that's a weak retracement. That's a weak bounce. That's a strong bounce. But where is the next thing? If you break, so in other words, if you fail the strong bounce, you're probably going down to a strong retracement. The strong retracement is another 400 points below, and that's the 4,000 line. And you can see that's exactly what happened. The strong bounce failed. Now you go all the way back to the 4,000 line. And in this case, so we actually went to 3,600, and that's really bad. That was not even expected for what we're doing. And I'm not talking about this strong retrace line. I'm talking about the strong retrace line of this nearer term thing. This strong retrace line is from way back in the dark ages. But there's been no reason to change the chart because it's still obeying this chart. When we were up here, we actually changed the chart for a bit because we thought we were finally breaking out, but then we had this and we went back to the old charts. This chart's from quite a long time ago. This is from the COVID recovery. In fact, that's when we made this chart. And we've been obeying it for the entire time of the COVID recovery, except now we're back to the top. So we had a chart where we based on 4,400, giving the S&P the benefit of the doubt, but it's failed there. That chart never came close to being satisfied. So we're back to the old original chart and our old original targets, and this is from post-COVID. This is what we determined would be the fair value line post-COVID. And I am willing to concede with inflation that it should be 4,400, but the market isn't acting like it's conceding. The market isn't acting like it deserves 4,400 at all. So this is our second major test at 4,400. It'll be at 4,800, sorry. It'll be very, very bad if it fails. And this is not TA. This isn't anything about island tops or any of that nonsense. TA is a load of bullshit, where people try to interpret the lines and figure out what's happening, but that's not what it is. The charts are drawn based on mathematics, okay? There's the 50-day moving average, there's a 200-day moving average, there's where the actual stock finished each day. The only thing you can be sure about is the behavior of these lines. The 200 is coming to some serious resistance right here. And it's 200 weeks, so 200-week moving average is 4 years. So the 200-week moving average is just now hitting here at the same time that the 50-week moving average, which is the 200-day moving average, right? It's 200 business days, not days. So it's 200 business day moving average, but when you talk about the weeks, it's actual weeks, not days. So it ends up being basically the 1 year average. So the 200-day moving average is a year. The 50-week moving average is also a 1 year period. When you look at this, and again, those little facts, though, those little tiny things are not what you think they are, is why, TA people don't take that into account. They don't even think about that stuff. They don't take into account the volume. If the volume is weak, then you discount the movement. Doesn't, you can't move up on small volume. You can't go down, look down, large volume, large volume, large volume, large volume, and then some pretty small volume to reestablish the high. So that means this was draining money out, draining money out, draining money out, and then this tiny amount of money came back, except that you went up higher than it was before you left. That makes no sense. That means that you now have a much weaker foundation than you had before, and much weaker, because look at the ballistics of this compared to anything else. We went from 4,100, which is here, to 4,800 in middle October. Let's call it 2 months. This took, what month is this? This is June. So this took from June until December, 6 months to hit 4,800. So this is and even this move, although you can argue it was because of the banking crisis, but even this move had a better basis than this move. This move has very little basis. There's just not enough actual, you're not putting enough bricks in the wall. Okay, you're building it really fast and really high, but you're not building a base, and therefore the whole foundation can come and collapse very quickly and easily. So problem number one is you've got this, and also the dollar, as it weakens, reprices the market. So 5% of this move is simply because the dollar, and what's that? That's like 200 points. So 200 points of this move is because the dollar went down 5%. It repriced the index higher to make up for the lower dollar value. So there are several issues with this move so far. And then we got into like some of the bigger problems we have is obviously, how did we get here? How did this happen in the first place? This happened because since COVID began here, right? This is COVID beginning. Since COVID began, we put $11 trillion of stimulus, and not even the Fed balance sheet, actually. It's more like including the Fed balance sheet, it's like $18 trillion worth of stimulus plus Fed balance sheet. Well, let's say deficit spending, stimulus, Fed balance sheet, those three factors, $18 trillion in 4 years. That is $4.5 trillion per year on the average from our $22 trillion GDP. So 20% of our GDP is deficit spending, stimulus, and the Fed bulking up its balance sheet. 20% of our GDP. So when they tell you that the GDP is back to normal and things are back to normal, you don't know that for sure. Okay, you really don't, because we haven't really tried it without the training wheels. So that's also an iffy thing. And again, the removal, and then it becomes contingent. So now it's contingent on the Fed removing, not the Fed, the government, the Fed. Yeah, I'm sorry, the Fed removing the stimulus. That's number one. The Fed easing up on their balance sheet. So in other words, they're going to stop buying all the notes and everything that the government's putting out for their debts. The government's got to find other sellers for the debt. The government is going to, in theory, spend less. I don't see how that's going to happen, but we'll see. That also detracts from the economy, though, if the government spends less. So you're removing all the stimulus, and we haven't seen what's going to happen yet without it. Where is the money coming from? If we're taking it away, if we're taking away the government spending, we're taking away the Fed spending, and there's no special stimulus packages coming in, where is it coming from? And the Fed's removal of their stimulus and their balance sheet liquidity is contingent on the fact that they think inflation is easing. They think they're ready to normalize their policy and drop rates and so on and so forth. What if they're wrong? If they're wrong about inflation, then everything collapses right away anyway. And we really don't have enough inflation data to show that it's slowing to call it a trend. For instance, oil's back to $75 now. Where is oil? Oh, there it is. Well, now it's 74 because I had a terrible inventory report this morning. But oil went back up. Well, here you go. You can look over here. You know, we've been having a good old time in the last few months as oil has fallen from $95 to $75, or even less than $75. Oh, that's Brent, sorry. From 90, it was from 95 to 70 actually. So that's $25 of a pullback from 90. That's massive. And now it's bouncing. And again, what's the weak bounce? If this is 25, then the weak bounce is 20% of the drop. So 20% of 25 is what? 5. That's a weak bounce. That's all that is. It's not meaningful in the big picture. It has to get over 80, which would be the strong bounce. And you see how you have resistance up here? It has to get over 80, which is a strong bounce, before you can call oil in a real recovery. But already, if you look at the stocks like Valero and Phillips and other stocks today, they're up 10%. They're not waiting for confirmation that oil's getting better. They see oil is up $5, and all the refiners are jumping up as well, and so is Exxon and other people. That's driving the S&P higher. But if we go out to a weekly chart, you can see it doesn't look all that impressive, does it, when you look at it here? And on a monthly chart, so I mean, that's the big picture for oil. You know, what matters though is, of course, oil is significantly cheaper. Here's the beginning of last year. So oil is basically starting off this year quite a bit cheaper than it was last year. So that is going to be a benefit for companies. But this doesn't mean the drop in oil is over. This just means you're making a little bit of a bounce off a resistance line. There's really nothing so special about that. Until we're over this line, it's not going to mean much. And that's $90 already. And the indexes aren't too different. So the S&P came up here, failed. Second attempt is now, but if it fails this attempt, it could just as easily start going all the way back. And why is that? That was the other major point I was making this morning was, I'm not there. Why do I keep doing that? Okay. So the other point I was making was the GDP over the course of, one thing at a time. Okay, so here's the GDP. So the GDP before COVID was here. It was like about 21.5 trillion dollars, and now it's here, which is $22.5 trillion. It really hasn't moved very much. Had very, very little, like 5% GDP growth since COVID. And that's adjusted for inflation. If you don't adjust for inflation, our GDP is now almost $26 trillion of inflated dollars. But it's an illusion, and that's very important to understand. You know, especially when you're betting on these stocks, because you know you're paying these ridiculous multiples for stocks based on the fact that it seems reasonable given the market movement. But that's not how you should judge it. You should judge it, does it seem reasonable based on how much money they can make you versus other things you could do with your money over the next 5 years. That's what an investment is, and it certainly has nothing to do with a freaking chart. I don't care what the chart looks like. You're getting up to 25 times, 26 times earnings when you hit 4,800 on the S&P. The S&P traditionally trades at 15, 16 times earnings. This is insane. This is 40% over the norm. And what would the norm be? The norm is going to be around. Unfortunately, the norm is back down to about 3,200 if you look at it that way. I don't think they're that bad. They're more like 36-ish, about here, let's say. So this would be about the norm for valuation on the S&P. And even if you say 20x is here. That's what we allowed for. This is a little nutty. This is 20% more than 20x. That makes it 24, right? Very simple. It's all math. That's the thing. I mean, TA is all this bullshit about reading patterns into these things. That's nothing. It's the charts. The charts are just mathematical representations, and you can understand everything that's going on by applying math, not by applying, pictograms. It doesn't work that way. So anyway, so I made some notes about that, and I said, you can't pretend inflation isn't part of this. You can't pretend that it doesn't matter that we have this gigantic deficit now. You can't. And then I talked about COVID. COVID isn't going away. There's a new version of COVID that's going around. That we've had 1 million new cases since October 1st. It's only December 20th. So yeah, we averaged 2 million cases a month for the last 4 years. So since COVID began, we've averaged 2 million cases a month. 100 million people in the US have been infected, 1/3 of the entire population. And when I say have been infected, have been diagnosed infected. As you know, a lot of people get COVID and don't go reporting it to the doctor or the hospital or anything else. We don't have an official testing system the way other countries do, like China and Japan and people like that, where they test every person. Before you go to a mall, they test you, and if you come out positive, they label you and report you. We don't like things like that. That all sounds bad. But meanwhile, if you have an infectious disease, shouldn't you be labeled and reported? Should you be allowed to just run around on your own and go to malls and do what you want? Probably not. That's why they keep their infection rates way lower than we do. Should you be able to show up at your job as a waiter and serve hundreds of people food while you're infected? Does that really make sense? But that's what because again, the second I say, oh, they label you and test you, and everybody's like cringy about that. But the reality is, how else are you going to control a disease? It doesn't work, and we've proven it doesn't work because this is our chart. Here's COVID. Here's where we finally decided we better do something about it, as it was going critical and about to pretty much wipe out the country. We did start doing lockdowns here finally. They had an effect after a while, and now we've eased off, but it hasn't stopped. We're just accepting the fact that 4 or 5 million people a year are going to still get COVID. 4 or 5 million people a year. 600,000 people a year have heart attacks and have lung cancer each. So, so COVID, and not now, all these people aren't dying, of course, but you're talking about 5 million people a year, and there's variant after variant after variant. And eventually, we're going to have a variant that's going to be pretty deadly. And we're still going to have 4 or 5 million people a year catching it. Even more, because this trend is going up because we stopped the vaccinations. We didn't stop it. You can still get them. I just got mine. I just walked into the supermarket and I got my COVID shot and my flu shot. They didn't even charge me for it. And I didn't even remember to bring my medical card. They just they have it in the computer and they're like, yeah, here you go. It didn't help. I got the flu or whatever the hell I do have. So, that's still there. It's still a risk that's out there, yet we're now acting as if there's no risk at all. The banks just collapsed very recently, and we're acting like that's not a risk at all. Nobody fixed it. The government bailed out a couple of banks, but nothing actually got fixed. No laws were changed, no rules were changed, no major compliances were done. It happened, we covered it up, and now we're moving along as if it can't happen again. This is a little nutty, right? When you're paying record high prices for your stocks, you should be somehow more assured than this. And again, the debt itself is so massive. Where was that? Oh, there it is. See, still running from last time we looked at it. $34 trillion. That's our debt. $100,000 per person. $250,000, $60,000 per taxpayer, because not all these people pay taxes apparently. So for each so if you're a taxpayer, you owe $259,000. But don't worry though. Don't worry, they'll spend more. Next year they're going to spend another $1.7 trillion. So it's not like you're going to catch up by paying anything. The government is now spending $6.3 trillion a year. Oh, that's down here. So this is the actual spending. This is the official estimate. So the actual deficit is $2 trillion still. Isn't that insane? And they collect $2 trillion in income taxes, 1.6 trillion in payroll taxes, Social Security, Medicare, whatever, right? 400 million, that's not an error, 400 million is all corporations paying taxes. They make about 6 trillion, they pay 400 million, it's not even 10%. That's our entire deficit right there. If they paid the same level of taxes that people paid, we wouldn't have a deficit in the first place. So it's really crazy. Secret window, open, close. What the frick does that mean? I want an open sea. Ooh, Treasury wealth money. What on earth is this? Money supply. It doesn't help you click on it. Oh, I guess I just want to point some things at me. What's that? Oh, the wealth. I love that. The wealth of the top 1%. So the top 1% have 40% of the wealth, and the bottom 40% have 1% of the wealth. Well, that's not nice. That's not nice. Give some wealth away, guys. I don't know. They changed a lot of this stuff. I don't even know what these things are. I gotta go over this again one day. But anyway, these are real numbers. These aren't fake numbers. This is the actual numbers, and it's horrifying. The most horrifying is this one: interest on debt. This number used to be 300 billion. So we were paying $300 billion or less than $300 billion on our debt just a couple of years ago. Now we're paying 700 billion, and we're not even there yet. We're going to end up paying over $1 trillion a year just on the interest on our debt. That'll be 3% of this number. We're going to pay $1 trillion a year just on that. Now that means that we're going to have an additional 300 billion added to the deficit because we don't have that money. And that means of all government spending, 10% plus, you get up to 1 trillion. It's going to be 15, 16% of it is going to be debt. It's going to be just the interest on the debt. Not doing anyone any good at all, except for the banks who loan the money, right? That does them some good. Anyway, so back to that. And things have changed since the pandemic. Before the pandemic, services were 69% of the economy, and goods were, you have to look at the other side, goods were 31% of the economy. So now services have dropped to 67%, let's say, and goods have gone to about 33. Yeah, it makes sense, right? 67, 33. So that's been a pretty big change. And that was from being shut in by the pandemic, right? So people use less services. They're not out using services. They're not being massaged or whatever it is they're doing with services. You don't have, maybe you don't have maids coming to your house. Maybe you're not going to restaurants. You're not going to see entertainment. A lot of that kind of stuff. So services dropped off significantly, and they started recovering again, but pretty slowly. While goods, what else are you going to do with your money? People just bought stuff for their house, fixed up their homes, bought furniture, so on and so forth. It was a good time for a while for the goods people. Also, a lot of people work at home now compared to what used to be. And these are major fundamental changes in the economy. And so far, you're not really seeing the big downside to it, but you will start seeing the downside to it. And also interestingly, at the moment, AI is creating a lot of jobs, but the jobs it's creating is, I'm hiring AI consultants so that they can develop an AI system so I can lay off half of my workforce. Those are the jobs that are being created now. So at the moment, the workforce isn't losing their jobs because it takes a while to roll these automations in. But there's going to be a certain point we hit where companies are going to start doing massive layoffs because they don't need this many people to do the same amount of work. There's going to be more and more automation, and especially if these robots start kicking in. Amazon's already using a huge amount of robots in their tasks. Tesla has a very automated factory floor, uses much fewer workers than the other automakers. These things are going to keep spreading inevitably, and there'll be less and less requirement for human beings to do jobs. And that's going to be super disruptive, and it's not going to take that long to start happening. It doesn't have to happen all at once, it just has to happen enough that people every year get laid off. There's 165 million workers in the US. So if you lay off 1% of them each year, okay, if you laid off 1% of them each year, by the year 24, you'd be finally done with your workers. So somewhere between that and whatever is the truth. You're not going to lose all your workers, but you're also not going to take 100 years to lay them all off. Believe me. Basically 100 years ago, we had like Model Ts. And now we have rockets going to the moon and Mars and stuff like that. It doesn't take 100 years for us to advance from where we are now. So, people are going to look back 100 years from now and say, 100 years ago, we had these silly robot dogs from Boston Dynamics. And now we have, whatever. Now we have robot butlers in every house. It's going to happen at some point. And that point isn't from 0 to 100 on year 99. More and more and more, you're going to see automation taking over at a faster and faster pace. And it's going to be relentless, and it's going to cause social upheaval and all kinds of other stuff. Very exciting. Okay, oil we talked about, and so on and so forth. So now we have it where we're at. This is why we are concerned enough to hedge. This is why when we did our last portfolio review, when was that? Stock and options trading ideas. So we did our last portfolio review about a week ago. There's some money talk portfolios that was just on BNN. It's just on BNN last week on Bloomberg. Let's see. What was our number last week? Money talk 445,394. 445,394. So what is the money talk portfolio today? Good. 445,394. Money talk portfolio. 448 is actually not bigger. Well, it's a little bigger, 445. So it's up a few $1,000s, but that's in a week. So things are kind of crazy. And right, and we're going to talk about that. So I'm going to talk about, oh, no, not that. So we're going to talk about the December portfolio review. So that was December 12th. Today is the 20th. So the combined long-term and short-term portfolios were 1156 a week ago, and they're still right about the same number. One went up and one went down a little bit, but they balance out. And why? Because last week this chart didn't update, did it? No. So last week we had the NASDAQ was at 16,221, and today it's at well, it's closer to 17, right? It's not 17, but that's the futures of the NASDAQ. It's about 16.7, I think. Oh wait, I can probably tell if I look over at TV. The Dow is up 50 points. The S&P 4774 is up 6 points. The NASDAQ. Oh, that's not the NASDAQ 100. Damn it. 15. It's at 15 something, 15,000-ish. Anyway, so we're in the same place with the NASDAQ, though. We're back to where we called it an overshoot last time, and that's back to 30 times earnings. The earnings haven't changed. We're just testing it again. But the reality is 30 times earnings is only getting 3% back on your money on an annual basis. That's not good. You can get more money. I get ads every day for 4.5% from the bank. They'll pay me 4.5%. That's a lot more. That's That's not even 20x. And they're asking 30x for stocks, which are riskier. Well, theoretically riskier. This looks pretty risky to me, right? So in theory, riskier. But anyway, so we didn't improve our hedges because we had already in the short-term portfolio, we had already added hedges. We cashed out a couple of things here, but the hedges, SQQ unchanged and TZA unchanged. We did not change our hedges, and that's because we have very, very strong amounts. We have about $600,000 worth of downside protection from our hedges, and we feel that's going to be enough to offset a small, look, we expect a short-term correction, so we're not looking to offset a massive correction. We expect a short-term correction, maybe 20%, probably not more than 20%. You know, if we get back to 4,000, we're going to be very enthusiastically buying a lot of stocks. If we never get back to 4,000, well, that's why we have our longs. We have a huge portfolio that's full of longs, but this is just our hedges. But I really strongly advise having some hedges because, you know, again, that's the point of what we were just talking about. There's all these different things that could go wrong that are generally being ignored. So this spread, I said we bought back this, we did that, and what we protected from here is we'll get $576,000 on the hedge, and overall we have $485,000 of downside protection based on the math that we did to say if this happens, then this will happen. So a 20% drop in the NASDAQ is a 60% pop in SQQQ because it's a 3 times the ETF. And it's now 15,626, so 1526 times 1.6 is 24.4. And the same thing we do with the charts, right? It's just math. It's not unknowable. I don't need to guess. I know for a fact what's going to happen. Don't know. I know not. You know. I don't know. I don't know for sure we're going to have the drop. But if we have the drop and it's 20%, I know exactly what number we're going to hit. Therefore, I set up my hedges around the numbers that are known quantities. I don't have to sit there and have make-believe lines coming out of the chart to say anything. None of that. It's all bullshit. It's a fact. It's mathematical. And that's how we figure these things out. And TZA is the same thing. It's down at just under $20. What was that? Is that where it is today? Let's see. Futures, not futures, chart. TZA. Oh yeah, that is where it is today. So that updated itself, that chart. And that's where we're sitting at. So this is where we were sitting at back in late 2021. But you don't say it's going to bounce just because it was here, but it's going to bounce because you've drastically stretched the valuation. So our two hedges together have provided $663,000 downside protection if the indexes fall 20%. It's a hedge. It's like buying life insurance, right? When you buy life insurance, you say to your agent, if I give you $500 a month, then how much is my insurance policy going to pay out? He gives you a number. And it's written on the policy, right? If you die, you get this because you're paying that. That's exactly what a hedge is. It's a fact. There's no guessing here. It's math. We can do the math and we know exactly what's going to happen. We know exactly how much insurance we're getting. We know exactly how much that insurance is going to cost. If I know that, then I know that my bullish portfolios better make that much money back, and more than that much money, obviously, but the bullish portfolios need to make the money to make up for the hedges. Just like life insurance, right? There's no point, you don't over-insure your life. You may want to say you're worth $100 million, but if you're worth $100 million and the insurance company says, well, you're going to have to pay us like $1 million a year to cover it, or whatever. And you're like, well, I don't have $1 million a year. And they're like, well, then you're not worth $100 million, are you? You know, if you tell Bill Gates that he gets, you know, if you told Bill Gates he get $100 million worth of insurance for $1 million a year, he's like, okay, you know, that makes sense to him. You know, and he's perfectly happy to give you $100 million. I mean, I'm sorry, perfectly happy to give you $1 million a year. And if he dies, there's $100 million payout. No big deal to him. But to you, you have to do the math and say, okay, how much money, if I die now, how much money will my family get, and will it be enough to get them through, you know, the loss of my income, so on and so forth. And these are knowable things. These are quantifiable numbers. And you arrive at a solution that makes sense. You arrive at a solution that pays your family enough money, but without draining the money now. And there's payoff to that, and your accountant will sit there and run those numbers with you too and say, well, if you spend this much on life insurance instead of putting it into a savings account, it'll do this and that, and here's your window, and so on and so forth. You know, there's a lot to put into it, but it's all numbers. And stocks are not that different, okay? And the market is not that different. That's what we're talking about in the article this morning. It's like, if this happens, then that happens. And if this happens, then that happens. If this happens, then that happens. But there's no magical occurrences. And that's unfortunately where we are now. We're betting on magical occurrences. You're betting the S&P can keep running at 30 and 40 times earnings. And it's going to keep going up, and it won't have any reason to stop, even if it's only paying you back 2% a year versus notes that are paying you 4 and 5% a year. It's just not going to happen. That's not how money works. It's not how investing works. It's not how savings work. It's an unproductive use of funds. And you can put money into unproductive things, but if you constantly put money into unproductive things, you'll eventually find out why they're called unproductive things. Right? I mean, you can choose to build your, you know, you can choose to build a building, and you can build it on a solid rock foundation, and it'll probably be okay. It might cost more money to drill into the rock. It might cost more money for the location or whatever, but, or you can buy the swamp down the road and say, hey, I'm going to build my building in the swamp. And you build your building in the swamp, and it falls into the swamp, and you lose all the money from the building. Yeah, it's like, sure, it was cheaper to build there, but it didn't work. Everything is trade-offs, and they're knowable trade-offs. That's how society works. And a lot of times traders lose sight of these things because, you know, everything has trade-offs. You know, a car is built a certain way because there are trade-offs between the safety of the driver and how much safety materials need to be put in the car. You know, you can make a car 100% safe or 99.9% safe, but to do that would make it a very boring, you know, you could make a car that never exceeds 30 miles an hour, and a car that has like airbags from every possible angle and has foam bumpers and buffers and so on and so forth. It won't be practical. It won't be very drivable. It won't be any fun at all. It might be unbelievably expensive, but it'll protect you a lot better than a car does now. We choose the trade-off. We choose to have certain functionality in the car that may cause our death. And we get into the car based on that. We choose not to pay an extra $50,000 because we are more likely to die. You don't buy automatically the motor vehicle's top safest cars, you know, especially when they're like Mercedes or something like that. You choose to buy a less expensive car that is more likely to kill you. And it's the same thing for consumer products. You know, we choose to allow a certain amount of insect parts in our food, because if you didn't allow any insect parts in your food, then food would be 5 times more expensive. So we're willing to consume a few insect parts. You know, you can't keep all the bugs out of the factory. And if you ask the factory to do that, can they do it? Maybe. Or they can keep more, they can certainly keep more bugs out than they do, but every next level you go to reduce the contaminants in your food or your drinks or whatever is another X amount of money. And there's always trade-offs, and there's trade-offs to managing your portfolio. There's trade-offs to balancing your portfolio. There's trade-offs to hedging, which is the insurance for your portfolios. And you got to recognize them and be rational about them. Okay, and there is also And all that makes sense. But then when I say, and there's also trade-offs to how much risk you should be taking in a stock or in an index when it's trading at a ridiculous valuation, all of a sudden it doesn't sound right. This is the problem investors have, or more traders and investors. But this is the problem people have. They don't pay attention to the fundamentals. They think money is just going to just come from the sky and feed a stock. It's like you have to think about who's going to pay for these cars, who's going to pay for this service, who's going to pay for these AI chips. You know, like NVIDIA. NVIDIA has gone to some incredible valuation based on the fact that people think that the demand for AI chips will never stop. $500. All right, and what is $500? Well, we go over here and we say, and see, that's again, this is where TA is kind of bullshit, because this is what a fundamental analyst does. They go to NVIDIA and I say, okay, well, NVIDIA is $500. What's $500? $1.2 trillion of market cap, and they make they made last year $5 billion. Last year, and last year being 2023, they fiscal year ended whenever. But you know, maybe it ended in June, maybe it ended in October. I don't know. Actually, I could know because I got to use checks. Anyway. Huh, that's weird. Oh, it's not interim. No. Yeah. Oh, weird. All right, so their fiscal year ended on October 28th. Yeah, that answers that. So ending October 28th, they made $4.3 billion. Now they didn't even make more money than they made in 2022. Isn't that weird? And the stock went from, in 2022, same amount of sales. In 2022, they went from 300 to, and this is October of 2022, they went down to 116. Then in, actually really literally in November of 2022 is when AI started coming out. That was when we started getting the AI. And then people started saying, hey, NVIDIA makes the chips for these AI, boom, 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 up and up and up. Then we hit critical mass. It had doubled by May, and everyone said, doubled? Pfft, screw that. Another 30% by June in a month, and then another 30%, or no, I'm sorry, another 25% at that point. So another 25% by August. And that's where we are now. Now we're double testing this. But again, where are you? Even if you assume they make $30 billion this year, that's what we say it was, $1.2 trillion valuation. Yeah. So that's 40x. I know it's 40x. I don't do math. So that's 40 times valuation here. Then they're projecting $50 billion in earnings in 2025. But what's that based on? That's based on the fact that currently they're getting these insane amounts of money for their chips because there's a tremendous shortage of AI chips and people are paying through the nose. Companies have to pay through the nose to stay competitive. But is that sustainable? Intel used to have that kind of pricing power where PC companies were bidding against each other for who would get their chips for their PCs. Can't sell the PCs without the chips. And Intel had basically cornered the market on the chips, and it lasted for a while until it didn't. And NVIDIA will last for a while until it doesn't. And now generally, it takes a while to scale up these fab production facilities that make the chips, but you don't really know what they're going to be able to do with Taiwan Semiconductor and places like that, and Micron. So We will see. We'll see how long it takes. You don't know what Intel's going to do. Intel's going to come back, and Intel happens to be right now in the middle of retooling their foundries and building new foundries. If they stopped in June and changed their foundries and started making a lot more AI chips than they were making PC chips, because they were going to make these incredibly very, very powerful PC chips, but the money isn't in PC chips, it's in AI chips. And if Intel recognized that in the middle of the year and started changing what they were going to produce, and they haven't announced it yet because they want to catch people by surprise, that could stab NVIDIA in the heart. So they're trading 30 times earnings. Fundamentals do matter. They don't matter until they do, but when they do matter, there's nothing you're going to be able to do about it. Once people recognize the fundamentals, these guys are lucking out. They've got the hottest chip on the market, they got all the demand, and they were ready to make more. Doesn't get any better than that, but you have to recognize that if you're coming in now, they've already benefited from that. Their stock has already gone up like a rocket. It's already trading at a very high premium valuation. This is their forecast PE for when the stock goes back to when they're pulling in $50 billion 2 years from now, 2 full years from now. That's what this PE is based on. And by the way, that's a big problem in the market because as more and more companies start having their 2025 forecasts, the forward forecasts are looking towards 2025, and that's a long time from now. And you're paying those prices now when you come in. I'm not saying this is a bad stock. I'm just saying it's a dangerous stock. It's a slightly different concept. Whereas our beloved Apple, $3 trillion, but they make $100 billion. That's still 30 times earnings. That's even Apple 30 times earnings, because it's all madness. Everything's trading on the NASDAQ at 30 times earnings or more. There's very few things that aren't 30 times earnings on the NASDAQ. And that's, again, forward earnings. But at least Apple right now, 99 billion there, 100 billion here. Oh, sorry, 96 billion here. Now Apple is actually making 30 times earnings now. NVIDIA is projected at some point in the distant future to make 30 times earnings. We got to take this stuff seriously. So I'm not saying don't invest in things, but I am saying hedge. And we've never had less Apple than we have right now in our portfolios. It's just because it's been very expensive for a while. Basically, we started our new portfolios in May. Here, we started new portfolios in May. Apple was only 170 at the time, but we bought some, but it never really came down. It came down back here came back to 170 basically. But when we started our new batch of portfolios last May, it just never really came up as a bargain for us. So it's not included much in our new portfolios. Apple's in our butterfly portfolio. If we go back to the review, not there. No, wait. No. Oh yeah, portfolio review, right. It's actually in the butterfly portfolio right there, but only, like 10, 15 long, 10 short, not very big. I think we added to it here. Yeah, see? Oh no, we didn't even add to it. We just rolled. So we didn't even add to that position. So here's the butterfly portfolio, 251. And now it is 268. 17, the same portfolio that we had on the 12th, went from 251 to 268, $17,000 in a week. And it's crazy. But the market is crazy. Things are going, this is a Not a rational amount of money to be making. You should not make this much money this quickly. Because at a certain point, you got to say to yourself, where's it coming from? Who's giving me this money? And the answer is it's not. It's an illusion. It looks like you're getting rich, but you're only getting rich because you have stock and you haven't sold it. And if you try to sell it, you may find that there are no buyers actually willing to take that much, are willing to pay as much money as you have for your stock. And again, not you with your 10 shares or whatever like that, but when you're an institutional buyer and you want to unload several million shares of Apple for hundreds of millions of dollars, you may find that there is not too many people with a real bid out there for Apple, not at that price. And that's when the bullet hits the road. And that's where you get to these resistance points. Like when NVIDIA hits $500, that's significant. And $500 is where people who have a selling program, a trading program, and they want to sell their NVIDIA stock, they say, I'll sell it when it gets to $500. They don't say, I'll sell it when it gets to 502.36. When it's at 450, they say, we'll sell at 500. Let's start doing some selling at 500. The algorithms are going to round themselves off, and they'll end up at a number like 500 or something like that also. There could be many algorithms running, and many of them with different rules and different things, but on the whole, is what the 5% rule is all about. On the whole, they sort of average out, and they come out to like whole numbers in the 5% ranges. So, $500 is a point at which a lot of trading programs are going to kick in and sell NVIDIA stock. Now, and the same for $200 for Apple. A lot of programs are going to kick in and start selling. Now, the question is, will the selling overwhelm the buying, or will the buying overwhelm the selling? That's why it's a point of resistance. We don't know. We don't know for sure what's going to happen, but we can figure out from how quickly it's rejected and how harshly it's rejected. We can kind of start figuring out where who's dominating the scene. Are the sellers dominating, or the buyers dominating? And so you can have selling, and then the buy programs kick back in at a certain point. Let's say if it's Apple, it goes at 200 and selling programs kick in. It drops down to 195 and it stops. And then the buy programs start nudging back in, and they start bringing it back up towards 200. And then the sell programs kick in again and knock it down. Now, at a certain point, one of them is going to run out of money. The buyers or the sellers are going to run out of money. That's when something's going to happen. But in the meantime, you'll go up and down around a point of resistance until you start to see the thinning of the herd on one side or the other. Then you start seeing the advantage takeover. But again, even that, and like I said, that's just fundamental analysis. That's just looking at the numbers and seeing what's happening. Even that, though, is still subject to broader macro conditions. So what's the overall economy doing? What's happening for Christmas? How many people are buying iPhones this year? What kind of cycle are you in? Do the consumers have money? What kind of programs is AT&T and Verizon running to give you iPhones, and so on and so forth? There's a lot to it. But if you're going to be a good, solid investor, you've got to be aware of these things, and you've got to be watching the market and watching the dynamics and seeing what's happening. And that's what this is all about. We pick a variety of stocks that are value stocks. IBM, International Paper, Coca-Cola, Mattel, Pfizer, Philip Morris, which I think we got rid of, TD. Did we hear Philip Morris? Nope. We'll wait for earnings, or I'm not happy with the whole sector at the moment. And since I said that, it's dropped significantly. Yeah, so I was thinking about getting rid of these guys. TD Bank, Vail, which is our stock of the year, not doing well so far. And Whirlpool. There's a good diversified bunch of stocks. And this is a butterfly portfolio, so we're not really playing them to gain. These are the ones these are all stocks that we think will hold pretty much steady, and we're going to make our money selling puts and calls against it. The money talk, as I noted, that was up a few $1,000s since we did it. Who's this? Oh, and then here's the long-term portfolio, which surprisingly to me, we really couldn't find anything to cut. These stocks are too good. There's too many great positions in this portfolio. We cashed out AT&T, Allstate, speaking of insurance. So we gave up on them. We cashed that out. Beyond with big lots, and we're rolling that and getting more aggressive. Coinbase is the problem because it's going up so fast that the short calls that we sold are getting murdered. So we had to change that position around a bit. Crocs, we're rolling on that one. Cisco, we actually, we got a little bit more aggressive on Cisco. Ford we left in place. Foot Locker, we got more aggressive on Foot Locker, and they've come up a bit. That's nice. Gilead, GLW with a runner-up for trade of the year. Gold on track. Gold, I don't understand why they're still up. Physical gold. And again, this is all stuff you got to think about when you're trading, right? Here's physical gold, metal, gold, daily. Let's even say weekly. So here's 2023. So in all of 2022, physical gold was basically less than $1,900. And now we're starting over $2,000. We're starting, I'm sorry, and even this year, it was below 2,000 all year, obviously. Now we're starting at 2050. This is significantly up from last year, very, very significantly up, 10% up from 2 years ago. But Barrick Gold was higher in 2022, and it was higher last year. So this valuation makes no sense. So the physical cost of the gold, in other words, they're a gold miner, right? So what's their business? They take gold out of the ground. They have gold reserves, so it can't hurt them that they have 70 million ounces of gold reserves. That means in the ground. So it can't hurt them if the value of their gold reserves went up 10%, right? That can't be what's hurting them. If they're selling the gold that comes out of the ground for 10% more, that should be good for them. And their extraction costs, even if they were higher, they're probably not that much higher that it's impacting the difference in the price. So, and we know for a fact, in fact, and here you go. Here's let's broaden this thing so we really know what we're doing here. What was the extraction cost for gold for Barrick in 2022, in 2021, 2022, and 2023? See, this is what you use robots for. Go find me this information so I don't have to look. You can't assume that they're right. That's one problem, but at least it'll give you an idea, and you can tell if it's, well, if you know the business, you can tell if it's right or not. Barrick Gold. Oh, here you go. So their extraction costs did pop 20% in 2022, but apparently they've been getting it more under control in 2023. So it's not just going up. They had a blip, and they do have higher extraction costs, and they're getting it back under control. But the bottom line is, in 2021, so let's say they're paying $200 more for gold than they were in 2021 to get it out of the ground. But the customer from 2021 was paying $1,800 an ounce, basically the whole year. And now they're paying over 2,000 an ounce. So the customer is paying 200 plus more. So they're making as much, no, they're not making a lot more money, but they're making as much money. But the thing is, if gold goes up another 10% and Barrick doesn't have another 10% increase in their extraction costs, it's all going to drop to the bottom line. And since their extraction cost was $1,200 on $1,800 gold, here's the trick. Their extraction cost was on $1,800 gold, their extraction cost was $1,000. Damn it. Where are these numbers? Nope, that's not it. What I just hit. Good webinar. Bing, bing, bing. Oh, there it is. So their extraction cost was $1,000 when gold was $1,800. So they're making $800 an ounce. Now it's $1,222, but the gold is $2,049. So they're making the same $800 an ounce. But what happens if it goes up $200 more? Then they're going to be making $1,000 an ounce. So they'll be making 25% more money on a 10% move up in gold. So that's huge leverage you have playing a company like this. And we know the history of Barrick Gold. We know that they're always going to drive their extraction costs down, that they're very focused on that. That's it. The main philosophy of the company is to have the lowest extraction cost in the business. And they're like, well, if we have the lowest extraction cost, we're always going to do better than our competitors, which is, you know, basically true. So we like them, and all that, by the way, translates to me saying on track. So we're good. Here's Intel. We did some rolling, so we got more aggressive. Here's JP Morgan, rolled and got more aggressive, and it's been, whoa, look at that pop since then. Holy crap. I mean, this, you know, this was from, you know, a week ago. 1, 2, 3, 4, 5, 6, 7. Holy cow. That's just crazy. Levi's is another one I like. Lovesac, we got aggressive. Macy's, we got a little bit more aggressive. McDermott, good for a new trade, I said. It's coming up a bit. Here's MO, we didn't cut it. I was thinking of cutting it, but we didn't. MP was another one that was runner up for trade of the year, doing well. Pfizer, yeah, well, say, all right, so I say clearly we buy back the April things. We'll buy 40 more longs. So we got very aggressive on Pfizer, and we're waiting for the bottom, and hopefully this is the bottom. Oh, I'm sorry, this is a weekly chart. So forget what I said. This is a weekly chart. So since last week, that's what's happened. That means on the one we were just talking about was JP Morgan. Yeah. So just did, well, still huge. I mean, that's what happened since we did it. But yeah, these are weekly charts, not daily charts. And here's Qualcomm, also huge pop last week. Here's SQ. Oh, Jesus, everybody's like, it's just incredible, isn't it? Ooh, SunPower was getting back on track, but it just got killed. Here's Trox popping up. Here's Vail popping up. UPS Vail. VFC is working out. Whirlpool working out. Even ZM, even Zoom Video. Because again, people were writing these guys off as if, you know, people were writing them off as if you're not going to use Zoom anymore just because people are going back to the office. But not everyone's going back to the office. Zoom still has a place, and the, you know, and not only that, it's being used just because it's a good tool. It wasn't a gimmick that only is for COVID. It's a good, solid tool that very many companies are using. It's a great way to conduct meetings. I just got interviewed on Zoom. First time that's ever happened. And they were talking about it. The technicians on the Bloomberg interview were saying this was a great quality. They were very pleased with it. They just started using Zoom for their videos. So if they're using it, it spreads and spreads, and more people do it. And as you know, there's a billion podcasts and all these different interview things. There's a lot of reasons this is still going to be a company and still going to be effective. You know, people decide something's a fad without any actual basis for saying so. Andrew says, can you comment on natural gas? I can comment on natural gas. Let's see. Energy. All right. There's a lot of moving parts to natural gas, but this is, first of all, the most important thing you know. When you get down to $2, again, extraction costs, right? That's what it costs to pull natural gas out of the ground. It's about $2. So it can't really go much lower than that, because if it does, people are going to stop pulling it out of the ground. You shut the well down. If you're losing money, if you're losing money selling the gas, you're going to stop selling the gas. But there's a caveat to that, because $2 is the all-in cost. $1 is the cost of building the well, and that's a sunk cost. Okay, you already spent it; it's already done. On a go-forward basis, your cost of extraction is basically $1 to extract the gas, and you make up your sunk cost along the way. That's theoretically over the life of the well. You're distributing the other $1. So it's $2 combined, but the actual cost on a daily basis is $1. Now, if the bank says if you owe the bank $200,000 this month for your note, right? And you generally sell 100,000 cubic feet of natural gas for $200,000, or you make a profit, or you sell it for 300,000, you make a profit. Now it gets down to 200,000, and you're like, well, wow, it's like you're like, well, I'm not going to make enough money. But okay, you're not going to make enough money, but if you don't do it at all, if you don't pull it out for $2, you're going to have to come up with 200,000 out of your own pocket to pay the bank. So would you rather sell the gas and give the bank the $200,000 from selling the gas, or would you rather shut your well down and pay the $200,000 out of your pocket? That's where, again, trade-offs, right? Everything is trade-offs. So, the well owners have to have their own breaking points and make their own decisions. Now, at a certain point, the well owner is going to turn around and give up on his well, and he'll sell the whole well to somebody else who takes over the loan or does whatever, and they buy it for a discount. Then their net cost for gas may be $1.50 by the time they're done. That's what happens in a recession. That's how recessions can adjust pricing, because people go bankrupt and lose their money, but somebody else comes in and has a lower cost basis than the people who were bankrupt. And that works with housing and hotels and buildings and everything else. The government keeps stepping in and stopping us from having these corrections, but the corrections are what makes prices come back to a realistic point. It's very messy when you fiddle with the economies like this. So anyway, but the bottom line is, effectively, $2 is the point at which you start to see some people shut down their production, and therefore it's a reasonable floor that you can expect to get back to, put it that way. Because wells do deplete and they outlive their lives, and then you have no gas, and then the gas becomes more valuable because of that. There's also a huge dynamic though in terminals. We're building a lot of natural gas terminals, and the new terminals are the biggest buyers of natural gas in the world, because they're buying incredible amounts of natural gas to compress and ship overseas. So when they're first building up their reserve, when the new terminal is built and it's got all empty tanks, and you want to fill those tanks, they have to buy incredible amounts of natural gas. And that sucks it up and takes it off the market and keeps the prices up. But what happens when one of these terminals is denied a permit? Or what happens when one of these terminals has to shut down or has maintenance issues? Or what happens when the shipping through the Suez Canal ties up? Now people who were going through the Suez Canal to deliver something now have to go all the way around Africa, and adding like a week and a half, 2 weeks to the trip, because of the problems we're having in the Suez Canal. The Panama Canal also is running dry, and people are having to go all the way around South America to go around the Panama Canal, because water shortages are causing the canal to slow down. All the shit stuff you have to pay attention to if you want to figure out the price of natural gas. Anyway, so the lack of ships means the export terminals are overflowing with natural gas, and then there's no other, and you can't build more natural gas tankers quickly. Therefore, They end up no longer selling the natural gas. That gas is now trapped in the United States, and they are desperately trying to sell back the gas in their tanks to the U.S. market because the export market has been completely cut off from them, and they also have to pay their loan at the end of the month. So it's very, very tricky, the natural gas market, while we're building it. Then you've got the nonsense where Russia might cut off Europe's supply, and that makes Europe want more gas, and that brings the prices up internationally. But if we can't ship it out, if we don't have enough ships to ship it out, how does it benefit us? You know, I could have avocados here, right? And my avocados are what, like $2 each, right? So I got avocados, $2 each, and I got a farm full of them. And you come up to me and go, you know, in Japan, they're paying $5 an avocado. And I'm like, oh, that's great. How do I get my avocados to Japan? Well, you could put them on a boat, but they'll be rotten by the time they get to Japan and worthless. So all I'm doing is taking my $2 avocados and turning into $0 avocados. That's not going to work. I can put them on a plane and fly them there, but let me see if if it costs me $500 for a ticket, right? And I don't weigh 500 pounds, so if I weigh 250 pounds, cost me $500 for a ticket, then I'm paying $2 a pound to ship by air. You know, and freight might be a little cheaper, but even if you figure it's going to be, even if it's going to add $1 per avocado, that's a big cost. You're looking at a farmer who only sells them for $2. Maybe you're going to get $5 in Japan if you put them on a plane and send them there. But now you've got a $3 that you got to cover, and they're telling you that you're getting $5. But unless you have a contract that says $5, you're probably not going to want to take the chance and put all the money up front and so on and so forth. And what are the conditions? And how often do they get ruined? And do you have to insure them? And what are the customs charges? Blah blah blah. It's a whole thing. So just because something is more expensive somewhere else and you theoretically can sell it somewhere else doesn't mean you will be able to. It's like Alibaba. Is it Alibaba? Yeah, I'm pretty sure it's Alibaba. They're the ones that have like everything. I don't know if I'm thinking of Baidu, Alibaba. I'm thinking of Alibaba. So Alibaba, if you ever go to Alibaba's site, well, here, let's go to Alibaba's site. Alibaba. Okay. Alibaba has everything. This is where you buy. This is where you buy everything in the world. Okay, so if I want t-shirts, let's say I want to do a t-shirt business, right? So I say t-shirt for men, wholesale. Okay, US sizes. I mean, this is mind-blowing for people who haven't seen it before. 41 to 97 cents a piece. $2 to $4. That depends. This is probably a very large amount of pieces. Depends on the material. This is not cotton. This is polyester. These are vintage wash t-shirts, $2.99 vintage wash t-shirts. These already have stuff on them. You got to watch the spelling when you deal with the Chinese people. You know, here you can tell them your logo design. They'll put your logos on it for you. Custom fabrics, custom colors, different sizes, different things, blah, blah, blah. Anyway, this is where you buy stuff, but it's not enough to just buy. It's not enough to just say, oh, I can get these t-shirts in China for this price. It's how, you know, what happens if there's something wrong with the shipment? What happens if the quality is a problem? What happens, you know, how insured is it? How much is it going to cost you to bring it through customs? How much is the shipping going to be? So on and so forth. You know, because, you know, let's say in the US, you could buy these shirts for $10. But you know what? I can buy them in the US for $10 and I can make a phone call and the shirts will be here in 2 days by UPS. And if it's a problem, I send them right back and the guy takes them back And if it's something needs fixing, he fixes it. If we need adjusting sizes, so on and so forth. So is what I'm saving buying the shirts from Alibaba enough to justify all the hassle I'm going to go through to make something happen? But you look at this and say, there's some kind of business here, right? Even if you double these prices and say, I want to pay $7 a shirt, $10 a shirt, then it's hard to say how you're going to lose money if you're going to be able to sell these things. And it's everything though, no matter what you think of, they've got it. I mean, if you say Swiss Army knife, there you go, $1.20. Whatever that is, that's nasty looking. That one looks cool. I like that. $6. And these are things you pay for $20. Honestly, there are a million businesses where you could just go set up a thing at a flea market and just sell whatever is popular at the flea market where you get it from Alibaba. But it takes several weeks to get it. It's going to come by ship. You're going to have to pay customs. You're going to do clearance. If God forbid the papers aren't right, the whole thing gets sent back. And again, dealing with the manufacturer, if there's a problem, if you get something that's not what you thought you were going to get, it's a lot of stuff. But it's a lot of stuff where you could make a huge amount of money. This is the entire way the dollar store does their business. Let's say we do a 80-inch, oh, there you go, smart TV. See how easy it is? 80-inch smart TVs. Oh, there's one of those laser ones, 4,000. Are you kidding me? Advertising wall LED screen display, $129. You kidding me? And again, I have no idea whether these are good or not, but I guarantee you some of them are fantastic. I bet if you did the research and really got into this stuff, you would find out some amazing stuff. But it's like anything else, though. You got to put in the effort. It's the same as a stock, though. You've got to put in the effort and figure out, is it really a good deal or not? And that goes for your strategies and how you set up your portfolios and how you look at everything. And that, and so it's really about just balancing out your portfolio properly, picking the right amount of hedges, and picking the right kind of stocks that are going to perform in this nonstop up environment, which is crazy. And and it's not like we're bearish. We're not bearish. We have all these are bullish positions except for the first few, except for the short-term portfolio way at the top here. All these are bullish positions, page after page after page after page of bullish positions. That every time you see blue, it means we put money into it. We've put more money to work to increase our bullishness. But it's because we have numbers attached to these things. If you look at the well, here's that $700 a month. No, that's not can't be a $700 a month portfolio. Wait a minute. Oh no, we did that review already. That's why. The butterfly portfolio, the income portfolio. Well, if we go back to the money talk portfolio, let's do that. That's going to be very detailed. So in our review of the money talk portfolio, and that has a hedge in it, actually. It has the SQQ hedge in it. So in the money talk portfolio, here's an important thing also. We don't do this for every portfolio every time, but here we did it in this one. We certainly expect them to make the last 1425. What does that mean? It was a short put. There's $1,425 value remaining in it. And if it expires worthless, if it stays above 100, it's at 140 now. If it stays above 100, this will go worthless. And we keep the money. So it becomes a gain of $1,425. So I said, we certainly expect them to make that last $1,425 for us. So all we have to do is just sit on it and wait 1 year. Barclays, we have $6,000, $6,750 left to gain, which is 37% left to gain. And there's a combination. And again, trade-offs. How confident are we that, oh, I'm sorry, that's SPG. Here's Barclays. So how confident are we with Barclays? The spread on Barclays is a $5. We sold the $7 puts. That's the high end of our range of $7 that we expect. So how confident are we Barclays will be over $7 for us to make our last 36%? If we're 90% confident that we're going to make the money, then there's no reason to take it off the table. If we're only 20% confident, I don't know if I want to wait. And here's Barrick Gold, same thing. I said, let's buy back the 17 calls because it makes us more aggressive. And we have $13,000 upside potential. IBM, 30% left to gain. Intel, 29% left to gain. It's $16,000. And I said here, it's a $75,000 spread. They're a mile in the money. I think it probably is. I think the payoff's at 35 or 40. So they're completely in the money, and we're going to make 29% if they just don't go down. Lovesac, 80% upside potential, and we got more aggressive because we feel very confident about that. Qualcomm, again, we got more aggressive, same kind of thing. 893% upside potential. Let's take a close look at that one. You know, I mean, there's a reason this portfolio is up 350% because these plays are amazing. So what have we got here for Qualcomm? We sold some 130 calls. We own the 100 calls. So we basically have a 100, 120 spread, but we sold some 130 calls. Those are going to put us in some trouble. I think we bought them back though. Oh, we rolled the short 120 calls. Oh, I see. We rolled the 120 calls to the 130 calls to widen the spread. And we're kind of planning there'll be a pullback, so we didn't do anything about the short calls yet. But if it all works out, it's got a $35,000 upside to this spread. You know, and again, you should be like this with every position in your portfolio. You should know exactly how much do I expect to gain, under what conditions do I expect to gain it, and am I on track or am I off track? If I'm off track, I need to do something about it. If I'm on track, it's fine. Here's SoFi. Our goal was 10. It's a $48,000 spread at $20,000, so we have 132 upside potential. And here we are closing in on 10. Here's SunPower. Had a big drop off this week, but we're fine. I mean, we're not really, you know, they had they issued a going concern note because they had to, because they fell out of their covenants with the debt, and if the banks refuse to renegotiate the terms, they're out of covenants because they didn't report their financials on time, and that calls them to technically default on a loan. If the bank, they have since reported their financials, the bank has not yet told them that they're going to allow them to skip this, the compliance issue. If the bank doesn't let them skip the compliance issue and calls the loan back, SunPower's like, we don't have this money. Therefore, they're required by the SEC to list it to put in a notice saying they may not be a going concern. It's a little harsh, but those are the rules. So anyway, so we like them, and there's 2,800% upside potential on this. But you know, it's 2 years from now. And 2 years from now, we think SunPower, we have a 3.7 spread. The stock was at 522 last week. Now it's at 460 something, but we're still in the money. But we want to get to 7. So our goal is to get here in 2 years. If we get there, we're going to make $38,000. But you know, this is the joy and sadness of being a fundamental investor, right? We're waiting for the fundamentals to kick in. We think this stock should be priced at a higher price. It hopefully will be. It'll hopefully be there in time for it to realize for the play that we have now. If not, we'll make an adjustment. And hopefully they don't actually go bankrupt. Hopefully bad things don't happen. You can never be 100% on it, but when your winners pay you 2,800% and your losers lose 100%, you can manage a few losses. It's not that bad. And then here we have hedges. We know exactly, we have $124,000 of downside protections from our hedges. So that's plenty to hedge this entire portfolio. Yeti's going to pay us 105% on that trade. So it says our 10 current longs have $166,000 of upside potential, and we have $124,000 of, well, not upside, downside protection. So we're nicely balanced on this, and as I said, it made a few $1,000s this portfolio in the last week, but that's exactly what we wanted to do. We wanted to do nothing. We parked the portfolio in neutral for now. You know, those other trades will kick in and make $166,000 if the market keeps going up. That's not our concern. Our concern is, what if it doesn't keep going up? What if something bad happens? So for the moment, we have a good amount of protection. That good amount of protection for the moment is stopping us from making a large amount of money even when the market runs up. But it's also keeping us safe and allowing us to enjoy our holidays. And that's really the point, right? It's like, you know, you've got this money out there and the money's at risk. You need to insure your risk. And that's what hedging is all about. Hedging is our way of buying insurance against the risk we've taken in our portfolios. But if you don't balance it correctly, you're never going to make any money. So at the moment, we've shifted to a neutral position in our hedges. We've got 160,000 to the upside, 124,000 to the downside, and it makes it very hard in the very short run to make a lot of money. But over time, we would, as if the market seems stronger over time, we would loosen up and have less hedges, or maybe sell some short positions against those hedges, and that would then mitigate the losses on the downside protection. And at the same time, we wouldn't need to change anything to make 166,000 in a bullish market. But the question is, what if it's not a bullish market? Then what are we willing to lose? And that's where the hedging calculations kick in. All right, that's about the end of my voice. So that's it. That's it for Christmas. I can't believe it. We're already there. Just several more days. It's the 20th already. Oh my gosh, that's just crazy. So I hope you guys have all had a nice year, and I appreciate everybody coming by. It's been very interesting, and we've had a really eventful year, if you think about it. There's been a lot of stuff going on this year, and it's even crazier. All the crazy stuff is carrying into next year, so it's going to start off more volatile than last year, and last year did not get off to a good start. So be very careful out there, but have a very happy holidays. Enjoy yourself with your family, and I will see you guys. I'll probably do one next week. I don't see any reason not to. So probably we'll do one more before the end of the year next week, all right? But Merry Christmas, everybody. Take care.